Hey everybody, it's Chris with Life 180, and I am back here today with Galen Nuttall with Canadian Whiteboard Finance. And today's going to be fun. We're going to talk about kind of a infinite banking 101 for Canadians. And so, yeah, man, I'm Galen. Thanks for being here again. I'm super excited about this. I love talking about this stuff, and I think it'll be a really valuable video for anybody in Canada who's trying to figure out, ultimately how to get started or have more clarity about how they could ultimately get an infinite banking type policy started in their life. So how do you want to start? Where do we want to start with this?
Yeah, absolutely. And as always, thank you for having me on. Happy to jam out a little bit more. Yeah, so I think this is kind of based on a comment that I got recently on one of the videos, and it was basically talking about the philosophy of the infinite banking and the nuts and bolts. Like there's a philosophy behind it, but there's also like an actual step-by-step process to figure out what makes sense. And so I think that it would be cool to get back to basics. We've talked a bit about different types of people for whom it's a good fit. And I think we could get back to basics on just like, what does it look like? As opposed to like maybe a more traditional way that people go. And I can even base it a little bit on a case I'm working on right now of someone moving their money from some of the more traditional savings like vehicles to this and seeing what makes sense for them, like moving towards the infinite banking concept.
Fantastic. So just so everybody knows, we don't script these out. This is just going to be a conversation where we're going back and forth and kind of having this, like, this is not scripted. So hopefully what comes out of this ends up being huge value, which I think it will based on where we're going. So, so what I see, and just kind of before we get into this, I was actually having a conversation with somebody about this the other day. What's really interesting, talking about the philosophy before we get into the nuts and bolts. I think, to me, what I love about the infinite banking concept and where it's so powerful is that it is pure, like, Austrian economics in effect, like free market capitalism, right? And I know for some people, they don't really see eye to eye on that. And we live in this Keynesian economic world where governments are printing money and raising interest rates and lowering interest rates and doing all these things to kind of manipulate the money supply and kind of the economy and all these different things. And some people look at that as a really positive thing. Some people look at it as a negative thing. I look at things as an entrepreneur and as a capitalist, and I try to like view everything through the lens of, okay, if you are your best asset, if you're an entrepreneur, then there's really nowhere you can put your money that's going to get a better rate of return, or that should be able to get a better rate of return than you can get in your own life and your own business, right? Like, that's just my fundamental belief. What I would say philosophically out of the gate, as we get into this, is that if you don't believe that in your core, in the foundation of your life, it's probably not the right fit for you. You know what I mean? Like, just philosophically, right? Like, if you don't believe that you're the best investment in your life, that your business, that your ability to take a system, a financial system that gives you liquidity, use, and control of your money, and gives you a ton of other benefits that you can leverage inside of your business, whether it's real estate, whether it's some other venture that you have going on, that access to capital, if you don't have access to that capital, there's a lot of opportunity costs that comes along with lack of liquidity, right? And so the liquidity in that money and what it allows you to be able to do and the returns that you can get in your life because of that, that's where the power of this comes in. So philosophically, that's what we're talking about. If you align with that mindset, I think you're going to want to really keep listening to this, because I think that's where this really impacts people in a positive way. People who don't get this, I find, are people that just don't get that component of it, right? Because if you don't understand, if you don't emotionally connect with that philosophy, well, then it's going to be impossible for you to really see the value in this strategy.
Yeah, for sure. And I think, yeah, I'm definitely getting what you're saying around the entrepreneurial mindset of, someone who's in the mindset of, I've grown a business or I'm growing a business, and they know that they can then take money and turn it into something that's going to create more money for themselves, whether through cash flow or like a new business or acquiring a business. Like, that's the mentality that we're talking about when it comes to what I would call like quicker access to the cash value of a life insurance policy. And the thing that I'll add is, the idea of building up wealth inside of something like a whole life policy can still make sense for the long term for someone if their jam is not to like quick access and use it again. Sure. It could still make sense for, especially in Canada, offsetting estate taxes. That's a huge, like when I run analyses on, do you just leave your money in those taxable accounts or do you slowly move it to a tax-free place? Almost always makes sense to do some of it because there's just so much taxes when someone passes away in Canada, or when they run out of places to put room in like government registered accounts. Like it still makes a lot of sense. But yeah, definitely on board with today talking a bit more about, someone having access to capital, access to liquidity while they're still building an asset inside of their business or like alongside their business.
That's awesome. No, I love it. And from that perspective, I'm a big believer that everybody needs to have an element of their retirement portfolio, savings, vehicles, whatever you want to call it, with a focus on investing for cash flow, not for accumulation. That's just my core belief. Because I think if you look at the world and the results that people are getting, when they're focused just on accumulation, it's that idea of putting money into an account where you don't know what the results are going to be at the end of the day, right? Like, and if you don't plan impeccably around it, you could find yourself in a world of hurt. Whereas if you're investing for cash flow, you have a lot more clarity and a lot more control over the dynamics of it all. And at the end of the day, nobody cares if they have $1 million or $10 million in the account at the end of the day. What they care about is their quality of life and guaranteeing your quality of life forever, right? And the only thing that has an impact on that is cash flow, right? And so, $1 million back in 1985, obviously with inflation and with interest rates and the fixed income markets and all that stuff would kick out a lot more money than $1 million does today. And so you have to really understand the environments. And that's why I think like when you invest for cash flow, you take a lot of the variables off the table. And that's why I love it so much.
Absolutely. Yeah, we've talked about this. Like in retirement, the people who have consistent cash flow are the people who have more peace of mind around their finances than people who have a whole bunch of money somewhere. Because, and I've noticed this, like I have clients who are retired, they retired, they worked for the government for a while. They have consistent paychecks coming into their account every month in retirement and as a pension. And I'm not going to have one of those. I'm not going to have one from a company. I have to create my own. Yep. And those people tend to be much more relaxed than people who know they have $1 million, because the people who know they have $1 million if all they have is $1 million worth of investments and not like a knowledge of how that can turn into consistent cash flow, then they're usually actually like they don't usually have a ton of peace of mind. Even though like $1 million sounds like a lot and all that stuff, but it's like, it's still, if someone doesn't know how that's going to turn into cash flow and they're not confident that they're never going to run out of money as long as they live, they are going to usually be stressed in retirement.
If you have it in the wrong areas, the concept of order of returns, and I don't want to go down to it's totally off topic, but the concept of order of returns is so important and it can totally devastate your portfolio. Like if in 2008 you had, $1 million in an account, and you needed to pull 6% off that for like $60,000 a year, that seems like it's a very doable thing to most people. But if then you have a 30% negative market the first year you retire, which is totally possible at this point, like it could happen anytime, right? Like, and if you're going to retire and then you're taking the 60,000 out and then the market goes negative 30, now all of a sudden you go from having $1 million at 6%. Now you got 640,000 and you still need to pull 6% or like 60 grand off of the 640. Your account's going to blow up, right? First, and it's not a matter of if we're going to have that 30% downswing, 25%, 20%. It always happens. It's cyclical. It's the question is, when is that going to happen in your retirement? If it's year 1 or 3 or 5, it's a problem. If it's year 15, well, you're probably okay. So it's just a matter of when does it happen and are you protected in any environment? And that's one of the things, like if you invest for cash flow, if you use infinite banking, that's why I love the infinite banking concept, is because it really gives people a system where they can invest for cash flow, right? And have much more control in their finances. And that's what this is all about.
For sure. So maybe what we could do is we could do a quick comparison of and I've got this a case I'm working on right now in mind of a business owner who up until now has been doing more of the traditional investing inside of government regulated accounts.
Mm-hmm.
And he's starting to see, okay, like I could use some more liquidity, I could use some more leverage, I could use some, like he's looking at different things he can be using.
Awesome.
So maybe we can just dive into that a little bit of like
Beautiful.
one side of the page and then the other side of the page sort of thing.
Do you want to whiteboard it or do you want to just talk about it?
Yeah, I'll whiteboard it, I think.
Oh yeah, I give you permission. You could share.
Cool. All right. So what I'm thinking is, and I mean, like as a quick caveat, like I'm not like making blanket advice for anyone to take it. Like if you're going to change anything about what you're doing, please consult with your professionals. Like don't just go out and do something and say, oh yeah, Galen said I should cash out all of my retirement savings and do this or that. Like I'm not saying that. I am going to talk a little bit about a case I'm working on, but it's not, this is not blanket advice. So we're just going to talk about general pros and cons and like, stuff like that. So
I think that's
my disclaimer.
That's always important anytime you watch any YouTube video on personal
Absolutely.
finance, I would say, guys.
For sure. Yeah, because I mean, like I talk to people, I'm like, where are you getting your advice? And they'll tell me where. And I'm like, okay, does that person know who you are? Do they have a vested interest in you being successful in life? And if the answer is no, I'm like, then, that's not someone who's in your life to like see you succeed. So I'll just put that there. So let's just say like, I mean, I'll just talk about like, okay, I'm going to talk about broad. So like kind of like the government account side.
Yeah.
Versus the, let's just call it the IBC side. So one of the things that this person came to me, they'd watched a bunch of videos and they came to me and they're like, Galen, so it's a business owner who, just like you said earlier, has that philosophy of, I know that I am a good investment. Like he's like, I'm an entrepreneur. I know how to create businesses. My business is booming. And it's like, I've got a lot of money locked up over here. Actually, I'm not going to draw up here. Let me draw a little bit lower down.
When you say a lot of money, can you give numbers?
I can give rough numbers, like let's just like say
broad stroke it.
Yeah, like let's just say someone's like, I've got $200,000 in a government account, and in this case specifically, since I'm going to talk about one of the most restrictive places to have monies, it's going to be the RSP, which in Canada, Registered Retirement Savings Plan. You put money in, you get a tax credit. When you take it out, you get taxed. So it's liquid in the sense that you can take it back whenever you want, but you can't leverage against it really. You can kind of borrow against it to like buy your first home or go to school, like go to school as an adult learner, but not like, oh, I'm going to borrow all this money to start a business, or I'm going to borrow all this money to like handle finances. It's usually put the money, leave it for a really long time and not touch it. So he said like, so what he was looking for was, let's just say like liquidity. And I'm actually going to,
talk about the traits of an investment or a savings vehicle.
Yeah, like let me see if I can't just do it like this. Like liquidity in the middle here. I hope I spell it right. Liquidity. There we go. So it's like, so we'll talk about like
later.
What's that?
There'll be a test on spelling later.
Yeah, I know. I'm a good speller, but I'm always like when I'm doing it in front of people, I'm like, oh man, I'm gonna get that wrong. Liquidity. RSP, there is, but it's limited in the sense of like you're going to get penalized in a pretty bit. Like
it's not great liquidity. It's not the kind of liquidity that you actually need to be able to like leverage.
Yeah, like so for example, like RSP room grows as someone makes T4 income in Canada. And so let's say that I've worked at a job for a while and I've got $100,000 of RSP room. If I put $100,000 in and then I were to take it back out, that room is gone. Like I've used up that room. And so I don't get that again, which because the government's like, you put it in, you got the tax credit. You take it back out, you can't keep getting tax credit. So it's like a very finite thing. As far as liquidity goes, I would say it has a very low level of liquidity for someone who is still actively working. In retirement, it's a little bit different, but it's very low liquidity. And I would say infinite banking, I would say it's high in the sense of you put money in and you can turn around and borrow a lot of your money back out without impacting the account. Would you say that that's accurate?
Yeah, I would say like, so I look at whole life insurance policies in this way where the liquidity is high because you have access to the capital. I call it collateral capacity inside of the account, right? So you're utilizing, you're never taking a loan from your policy. You're always taking a loan against your policy, right? Like, so the key word there is against, not from. And what that means is you are, your money inside your policy is used as collateral to access this capital, right? So if you had $100,000 in your whole life policy and you borrowed $50,000 against it, That's the key term. This is where people that don't understand it or that doesn't make sense to them, they think, why would I pay money to borrow my own money? Well, you're not borrowing your own money. It's having a financial system that gives you automatic guaranteed access to capital through investment or through loan vehicles. And because you have this solid financial vehicle that's guaranteed, the insurance company or a third party will lend you money, let's say 50,000, and you have 100,000 in your whole life account. Well, then your collateral capacity reduces from, by the amount you take the loan on. And then as you pay that loan back, your collateral capacity increases again, right? And so when the beautiful thing about that is that even though you may have to pay, let's say 3.5% to a third party to borrow money, for a loan against your policy that you collateralize, the great part is your money in your policy is compounding all the same, continuing. Yep. And if you understand the difference in the power between compounding interest and amortizing a loan, right? Yes. You're paying less and less interest every month as you pay it back, and this money just keeps compounding, right? Yep. So that's arbitrage, and you're able to create wealth through arbitrage, the spread, right?
Yeah, and I think
that's the power.
Yeah, and I think one of the ways I could put that in terms is like access. Like, how can you access this? Yeah. And I'll say that RSP has limited. There's more than one way. Like the main way is you take your money back out. And when you take your money back out, you get taxed on it. You lose the room, right?
Are there penalties in Canada?
There's not a penalty per se. Like the government will withhold a certain amount of taxes. And then when you go to like settle things at the end of the year, they either withheld too much or too little, and you have to make up the difference. So there's no real penalty per se, but it is taxable. Like I know with like the IRA, I think there's a penalty actually for taking the money, right?
Yeah. So with a 401k or any qualified money, 401k, IRA, anything like that, if you want to access it early, you have to pay income taxes the same as the RRSP, but you also get a 10% penalty if you access it before 59.5. So it's way worse. I mean, I just did a study in the United States. In 2015 alone, Americans paid $7 billion in penalty just to access their 401k money. Wow. $7 billion just in penalty money to access their 401k.
That's wild.
That's insanity.
That's wild. Yeah, I mean, I'd be interested to know how many people early access their RSPs just to take the tax, and just eat the tax hit. So you don't have a penalty per se. Like some people will call it a penalty. That's not really accurate. It is just your tax. You're paying your taxes back. But I'd say access is low again. Like there's really one main way, which is taking the money out. Mm-hmm. There you can technically borrow. Like you can access the money and like pay a down payment for your first home or like adult education, but you're not doing this thing that you're talking about where your money is left behind compounding. You're actually taking it out and you're using it and then you're paying it back.
It's an actual distribution or a loan again.
Yeah, it's you're accessing it, you're taking it out in a way that you're not taxed on or penalized, like you're not taxed on it, but you have to pay it back over time. And so it's kind of a way of people to be like, oh, I'd love to save for the future, but should I save for my home or should I save in my RSP? And so they opened it up a bit.
So you're almost like creating your own second mortgage on your home for the down payment.
Kind of, yeah. Like, I mean, you're not paying interest or anything like that, but there's a timeline. Like you buy the home and then once a certain time frame hits, you have to start paying this money back over time.
You're not paying interest on when you take the loan from it for the down payment of the house, but you have to pay it back interest free. But there is opportunity cost because the money is not working for you.
Absolutely. Yeah. Whereas over here, I would say that the access, I mean, there are multiple ways. For sure. Like you're talking about the collateral loan, you have policy loan, collateral loan. Those are the first two places I would look. You can do a corporate collateral loan if it's inside of a corporation. You can do a personal collateral loan. You can internal policy loan, or you can technically cash out some of the cash value. That I would say that's the last place to go.
Yeah, I would say that's the last thing to do. In the United States, I don't know how this works in Canada, but you can do a cash out withdrawal of the policy up to cost basis with no tax penalties at all.
Yeah, pretty much. Like, if the amount of money that someone has put in is about what the cash value is, you can be pretty confident you can take it back and not pay any taxes on it. It's once it gets above that point. Yeah. But it's like, that's the last ditch. Like,
you don't want to do that anyway.
That would be probably the worst way to access, but there are multiple ways. And the advantage of, just like you said, like your money is still working for you while you access it. And I think that's like another, like you said, use some fancy words there. Was it collateral?
Collateral capacity.
Collateral capacity. Yeah. So I think that trying to think of a way to put that into, I mean, collateral capacity is a good way to put it. It's very accurate, but it's like, it's kind of like, it's like your growth is not impacted. Like the core growth is not impacted.
I would just say uninterrupted compounding is really what
compounding. Yeah. Let's put it that way. It's starting to make me spell some really, really difficult words here, like interrupted. So non-interrupted.
I wanted to see you write out collateral capacity.
Yeah, exactly. Collateral's not too bad. It'll be like, let's talk about, just throw some really fancy words.
Nice.
There.
Yeah.
Non-interrupted versus interrupted. And it's kind of funny. So for anyone who's there's one concept. Like, so the other day, someone's like, I was explaining this to my parents, and they're like, I don't get how this works. This sounds like too good to be true. And then finally, one of the parents said, oh, it's kind of like taking out a home equity line of credit, or like reverse mortgaging your house. And I was like, yeah, it's similar in that if you own a home that's gaining value and you borrow against it, you technically have the asset that's still being worth more, and you're accessing the cash to use for something else. And I would say that's similar. The big difference being is that you don't live inside of your life insurance policy. So you don't have to worry about that. And at least if the last time I checked the rules in Canada, you can only access up to 50% of your home value. I don't know if they've changed that or not. Whereas with whole life insurance, you can access 90% or more of the cash value. So, but it's a similar concept in that you've got an asset that's growing and you're actually accessing it, the value, to do something else with it.
Okay. They only allow you to cash out refi up to 50% of your home value?
Yeah.
Oh, wow. Here it's 80%.
Yeah. Yeah. They did that just to try to protect people from, borrowing too much and then the home value dropping.
As a bank, like,
not using the thing you live in to just like spend.
Well, that certainly protects the housing market a lot more.
Yeah.
There's no doubt about that.
Because I think that caused a few problems back in 2008, 2009.
Just a couple.
Just a couple.
Hey, let me ask you a question about this, because I think from an X's and O's perspective, when we talk about this, I think this is really important. And we touched on it just a little bit a minute ago, but with the United States, if I've got somebody in a 401k, it's a really tricky conversation, because our tax environment in the US is a little different than yours in Canada, right? And you don't have the penalty, right? So it's a give and take. So in the United States, I talk to somebody and I say, listen, you just have to look and see, you have to weigh. It's always a function of weighing what tax bracket you're at, like that you currently are paying in. You always have to evaluate and talk to your CPA or accountant to make sure that when you do a distribution, that you're not bumping yourself up into bigger tax brackets, because that can cause more taxes, than you want to be dealing with. So you really need to be talking to a pro on that side of it that really understands your personal financial situation. But then there's also the 10% penalty in the United States. I'm a big believer, and this is just a matter of making sure that your investments align with your values, right? Like, and your beliefs, because the reality with all of this stuff is that this is just my opinion. You have your opinions, and our perspectives and opinions obviously sway our beliefs and how and why we want to do things, right? So like, if you are, I don't want to get into politics, but if you're more of a liberal leaning person that believes, in certain things, and you're like, okay, I think taxes are going to be fine. I think the government's going to take care of this and that and whatever. And you don't want to take all this risk on and whatever in the United States, then you look at this and you go, okay, I think putting money into this qualified account is great because I trust it. But if you're somebody who's on the conservative leaning side, then they sit and they go, well, I don't trust the government. I think taxes are going up. I don't trust what they're going to do with it. Our debt is out of control. Our spending is out of control. Like, and yet even those people seem to put all their money in a 401k or qualified account where it's just like totally at the whim of this government that they say they don't trust. And so what I'm a big believer in is like making sure that you invest in alignment with your values. And I think people aren't doing it because they don't understand like the correlation between the two and how to do it. Right. And so, for me, I'm in the United States, at least, and I'd be curious to hear this is my long way to get around to like how you view it in Canada is I the 10% penalty makes it a wonky conversation, right? Because people are like, I don't want to pay 10%.
It stings. Yeah.
But and that comes down to what your values and beliefs are. Like, we're a really low tax rate environment. I could show you history and show that taxes are probably going to go up. And the answer is, if you think taxes are going up by more than 10% in your bracket, well, take the penalty now and get done with it and have control and liquidity of your money and take advantage of different environments. You know what I mean? And I could make a lot of arguments why that's smart. I'm never going to argue with anybody to try to convince them that that's the right thing to do. Everybody's got to make their own decision. In Canada, though, it seems much more applicable where this would make sense to cash it out. And I'm correct me if I'm seeing something wrong, because you guys are already in a higher tax bracket environment. You don't have the ability for your taxes to go up at the same rate the United States does. So that's on the spectrum of saying, hey, if they're not going to go up much, why not just do it now and get control of my money? You don't have a 10% penalty. So as long as there's it's not bumping you, like the distribution you're taking isn't bumping you into a higher tax bracket, to me, it would just say, why wouldn't you want to gain control of that money, take at least a portion of your money and put it into an account that you have liquidity, use, and control of, that you could leverage and amplify the cash flow investments in your life?
Yeah, for sure. So from what I'm hearing, you mentioned, investing in a way that's in line with your values, like putting your money in a place that aligns with your values, whether those be political, personal, or like your own like business values, what you're doing there. And then also hearing that, you want to be smart about it, where you don't want to bump yourself up to a whole new tax bracket and lose out on the benefits. Yeah, for sure. And I agree with you 100% around what I find is people investing like not only in a way that's in accordance with their values, for sure, but also like not just doing what everyone else is doing because that's what they've been told. Like, there are a lot of people, I meet a lot of people in their 70s who have a ton of money in their RSPs, and I am the first person, like, I don't know how, but I'm the first person who's pointed out to them that they will lose up to half or more of what's in that account if they pass away before they deplete it. And I have met people who used to work for financial institutions that have a ton of money in these, and
when you say complete it, do you mean spend it all?
Unless you spend it all, unless you take it all out and spend it. Yeah, exactly.
That's a fun way to say spend it all.
Yeah. Unless you deplete it, like, it's going to be there and you're going to get taxed on it. And yes, it's good to take advantage of tax deferred compounding, like investing, sure. But I'd say that that's the biggest problem I see, is everyone just kind of does what kind of everyone else is doing, or like, they've come to some decision not based on their actual situation, but just on what they've kind of heard people do. Now, when it comes to like depleting or like taking early access of an RSP to put it into something like this, in the case of the guy who reached out to me a bit ago, it makes sense in his case because he really wants that liquidity. Like, he really wants it, and he's being careful about how much he takes out. He's not going to take it all out at once, because that would be a terrible idea, because it doesn't take long to get to the 43% tax bracket, certainly in Ontario and most provinces. Like, you get to 43 fast. You're still in the mid hundreds, low mid, like 130 grand around there. It's like, I ran some numbers the other day for someone, I don't know the exact number, but when someone's in the 130 range, they're 43% marginal tax rate. So you don't want to be tacking on another dollar unless you can avoid it in that year. So, I mean, the good thing about entrepreneurs is, if they've got some control over how much money they're paying themselves, they could maybe take less out of their company, take more out of this to count as income. Like, there's a lot of things they can do. So for this person, he saw that I really want liquidity. I really want multiple ways to access my money, and I don't have that right now. And he's also, just like you said, very confident that he can grow his business over the next 20 years to the point where this money will have worked far better for him now than it would sitting where it is right now. So yeah, I definitely agree with that, of people investing in a way that makes sense for their values, but also for their situation, which there's not a lot of that. Like, it's like, I think far too many people are measuring the value of their financial plan on the rate of return they got last year or any given year. And I think that that's a terrible benchmark, because it's fairly arbitrary, I'd say.
Well, and it's so short-term mindset. It's very, in my opinion, it's kind of a reactive approach, and it's an approach that you don't have control of the results. And like, whether you got 4% or 20% last year, that's not something that you can set an expectation around and build around that, right? And like build a plan around that expectation. And so, you that's where I get advisors sit there and they say, well, you got to have, you're going to have big years, you're going to have negative years, you're going to have mediocre years, but you got to kind of bank on an average. I'm a big believer that the average rate of return is the most overplayed conversation in financial advising. It's a very manipulated, arbitrary number that really has nothing to do with your actual money in your account. And I've done a lot of content on that over the years because it just is, to me, it's criminal to me, the way that advisors talk about the average rate of return, because it's very deceptive. But it just comes down to the fact that for me, having a system, it's about the financial system, being very intentional about the result that you want to create in your life, and being able to reverse engineer a plan to get there. And I think personally, having IBC as part of your strategy gives you a leverageable tool that you can have a more predictable result to achieve said goal. You know what I mean?
Like a very quick story around that rate of return conversation. So, and how I think it's an arbitrary, especially a 1 year time frame for me is a completely, almost completely arbitrary number. Cause most of the people I know, 1 year of a really good rate of return is not going to mean that they can retire successfully. It's going to have to be a big chunk of their lifetime of doing the right things along the way. Yeah. So I'm a member of this. So I belong to this charity and the board and everything. And a couple of years ago, there was a meeting where they're doing the year-end review. And they said, and I kind of assume people, I know I shouldn't because I didn't know any of this stuff before I became an advisor, but I kind of think people have a similar mindset around these things. Yeah. And we're at the year end and they said, this year, because we got really good advice on our investments, the charity made 6.5% in the market on the money we've got set aside. And everyone was clapping and everyone's all excited. And I kind of looked around, I'm like, why is everyone so excited? And I think it's because people think of things like, 2% or 3%, 6% seems high. Well, earlier that day, I had a conversation with the people who were managing this. And I said, have you guys ever taught the people giving to this charity how to donate appreciated assets to get a real great tax break? Yeah. And you get more money and they get more money and all. And I was just kind of talking to them. And I'm like, I'm sure they've done this by now. I'm sure they've educated everyone about it. They hadn't. And so I talked to people who are like, oh yeah, last year I gave $10,000. I had an investment worth 20. I sold it. And what was left over was 10. And I gave that to them. And I would just I felt like crying because I was like, if you guys were educating the people who are donating to donate in kind, everyone would win. And this 6.5% would feel I don't know, it wouldn't feel like this big win that you think you're getting. You'd have every donation would not every donation, but lots of the donations would be 30% bigger just because someone saved taxes. So this is kind of a story about there's rate of return and then there's other things that can be far more important behind the scenes that are more fundamental.
Well, it really comes down, the other reason I love IBC and that kind of stuff and those sorts of fundamental things, and it's a little different, but it's very similar, is financial efficiency is the greatest tool we all have. When you understand, most people are so focused on how do I get 7, 8%? How do I get to 10 or 12%? What people don't think about is when to get a higher return, you're inherently taking more risk. That's just the way it works. There's no way around that. It just is what it is. And I think one of the frustrating things for me is one of the biggest lies in financial advising told is the younger you are, the more risk you can take. I think we've talked about this a little bit. In my opinion, the younger you are, the less risk you should take because you have time on your side. And in order for compounding to really work for you, you need consistency and time. And so be contributing consistently, have time work on your behalf, and you're going to work out. It's going to work out beautifully for you. It's those big negative years that interrupt compounding. It's losing jobs and not contributing and not being consistent. That's what works against you. And so, I just think, man, I don't even remember where I was going with that exactly, but I just think ultimately it's kind of when you're looking at those expectations of returns and when you're looking at, kind of where people's mindset is around what they should be getting for returns and what their strategy is around it, making sure that you have a portion of your strategy that is, I don't know, enabling you to have a consistent growth that's not going to be interrupted, that's, going to enable you to take advantage of opportunity. You know what I mean? Like, that's the thing about this that to me is if that everybody's clapping at 6.5%, right? Like, what did the market do? Like, what would they have done if they just had it in, like, I don't know what you guys have there, but like an S&P 500 index fund, something of that nature, like the equivalent that you would have like up there, like, did the market do 8%? Like, did it do 4? Like, what's the relevancy of that? Like, of the clapping? Like, because if it did 10 and they got 6.5, well, then what are you clapping about? You lost,
Or how much did you get to keep of that 6.5?
Yeah.
Or like how, like, just like I said, like that 6 could have been 10 if they had educated enough people on how to donate in-kind appreciated assets and gotten huge tax refunds.
Oh,
the guy I talked to says, no, we've never taught anyone about that.
Well, and that's where I was going. I remember where I was going with this now. So the whole concept of financial efficiency is saying, like, most people are chasing these returns, right? Like, and it's like what you're talking about there is nothing to do with returns. It's all about financial efficiency for the people donating and for the organization.
Exactly.
What most individuals don't look at is, they're chasing these 12% returns. If you have, like, let's face it, the people who are just starting in their 30s and 20s and like low 40s, a lot of people don't have more than 50 to 100 grand saved yet. Like, that's just the reality, sad, but it's true, and if you have $50,000 in an account and you're trying to up that number, you'd be blown away. Like, in order to get 12%, that's a $6,000 annual like gain in your account, right? To go for a 12%, you're taking on a significant amount of risk if you're trying to get 12%. That there's just no way around it. If you're looking at the financial efficiency, you could go through your financial life and try to optimize all your finances, all your debts, all your insurances, all your protections, and like really just optimize to find $500 a month. That's $6,000 a year. You could get a 12% return with no risk inside of your life just by operating more efficiently. And that's what I'm really passionate about, is helping people see that. And this is the kind of system that can help you when the IBC policy itself isn't going to do that for you, but by having an IBC system in your life, it gets you to think about your personal finances in a different way. Where you take all that stuff into account, and it increases your intention and the efficiency in your financial life, which ultimately helps you get to where you want to go with less risk.
Absolutely.
I love it.
You got it.
Awesome, man. Cool, bro. So anything else on this that you think we should talk about in regards to Canada?
In regards to Canada, I mean, it's a similar setup. We've gone over some of the nuanced differences between it, but I mean, I would say that, really for someone to take a good look at where they want to be in the future and where they need to be putting their money away now, that's going to get them there. And I think for a lot of, like, I would say that this is the most underutilized financial concept around, especially among business owners. I would say it is highly underutilized.
Yeah, I think absolutely. And I think the business owners are the people that align with the why behind why they would want it in the first place. So it's kind of like, if you don't know what you don't know, if you have any questions, feel free to reach out to Galen. I'll put a link down below in the description and have a conversation with him and see if it's the right fit for you, and kind of go from there. If you haven't already, hit the like button if you found value in this. And as always, make sure you hit that subscribe button, click the bell. That way you get notified. Galen and I are going to be doing videos like this consistently. We have been. You can check out the playlist that we have going. I think it's like financial strategies for Canadians or something like that. You can check it out down on the channel page here. So yeah, man, that's it. If there's nothing else to go for this, I think this is awesome. I think people need to understand this stuff. So dive deeper, get on the phone with Galen, and yeah, for now, that's it. Have a blessed, inspirational day. We'll talk to you next week. See you guys.